An up and down week saw gold and silver end slightly lower than where they started, at least in dollar terms. Following a rally on Tuesday, gold was quiet on Wednesday, with US markets closed for Independence Day. Gold then fell on Thursday, as three major central banks all announced they were easing monetary policy. China's central bank surprised the market with its second interest rate cut in as many months. Around the same time here in London, the Bank of England announced a further £50 billion of quantitative easing. The European Central Bank then cut its main policy rate to a new record low of 0.75%. The ECB also cut its deposit rate to zero, meaning banks who deposit funds with the ECB will not receive interest on their money. This move by the ECB prompted Denmark's central bank to push its deposit rate into negative territory at minus 0.2%. The other market news on Thursday was the US ADP employment report. This privately produced monthly jobs report came in better than expected, giving the dollar a further boost against the euro, which was already sliding following the ECB announcement. Unlike the ADP release, however, the official non-farm payrolls report failed to beat expectations when it was released on Friday. According to the report, monthly job growth in the second quarter averaged 75,000 jobs a month, half the amount Federal Reserve Chairman Ben Bernanke has set as a minimum to meet Fed projections. Despite this, it would be hasty at this stage to conclude that Fed policymakers will launch a third round of quantitative easing when they meet in 3.5 weeks' time. Although it missed expectations, Friday's non-farms report also included an upward revision of April and May's numbers, while the unemployment rate held steady at 8.2%. Here in the UK, more and more people are questioning the economic benefits of QE. The impact on markets seems to be less substantial each time a new round is announced, and complementary stimulus policies are already in the pipeline, such as a funding for lending programme aimed at encouraging more loans from banks to businesses. This may raise the bar for more QE in the United States, especially with the presidential election on the horizon, with the Fed likely keen to maintain a veneer of impartiality. All of which may explain why the dollar continued to strengthen throughout Friday's trading, leaving gold in dollars slightly down on the week at Friday afternoon's London gold fixing. Sterling gold prices, however, saw a slight gain, while gold in euros was up 2.2%, suggesting that gold itself still lacks its own momentum, with its price action tied inextricably to currency moves. Next week sees the release of Chinese inflation and trade data, expected to be weak given this week's interest rate move. There is also the publication of minutes from the Fed's most recent policy meeting, which should give some indication of how Bernanke and co are thinking. To keep up with the latest in gold and silver, visit goldnews.bullionvault.com.